Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone.
Good morning.
This week, we're doing a deep dive into the recent financial news, really focusing on how the economic landscape seems to be shifting as President Trump wraps up his first 100 days back.
Right. And our goal today is to unpack the key takeaways from some big financial publications, look at how it might affect, your financial well-being.
Exactly. We want to bring some clarity to these, let's face it, complex issues without getting bogged down in too much jargon.
Absolutely. We've gathered quite a few articles, MarketWatch, Bloomberg, The Wall Street Journal, all from around late April 2025. So pretty current stuff.
Gives us a good range of perspectives, sometimes even conflicting ones.
Definitely.
Okay, so let's kick things off with the big picture. Trump's first 100 days and American finances. MarketWatch had an article, 5 charts that show how Trump's first 100 days have shaped Americans' finances. It paints, well, a nuanced picture.
It does. Interestingly, the initial data they looked at suggested consumer prices were relatively stable in those first few months.
Yeah, stable at first, but then comes the but.
Right. The big but is this growing worry among Americans about the looming impact of tariffs. People seem to be bracing for price hikes.
Already thinking about cutting back on non-essentials, it sounds like.
Precisely. And that shift in feeling that consumer sentiment, that's something we really need to watch.
Mm-hmm. And it's not just folks on Main Street. Economists are raising red flags too, right? About tariff-driven inflation.
Yeah, the worry highlighted in that MarketWatch piece is that this kind of inflation could basically tie the Federal Reserve's hands, prevent them from cutting interest rates.
Which, of course, makes borrowing more expensive, slows down growth.
And potentially bumps up the risk of a recession. It's a serious concern.
Okay, let's drill down a bit. How about specific sectors? Cars, for example. That gets really interesting.
It does. Car affordability was already pretty poor before Trump took office again. Remember, back in Q4 2024, almost 19% of new car buyers had loans over $1,000 a month.
Wow, nearly 1 in 5.
Yeah. And the average price paid, it barely budged between January and April this year. Still hover around, what, $47,000 something?
So affordability just hasn't gotten better, basically.
Not really, but then you saw that weird surge in March sales.
Right. MarketWatch called it roaring. Highest monthly sales in nearly 4 years. People rushing out to buy before tariffs hit.
That seems to be the consensus, like trying to beat the clock. Aaron Keating from Cox Automotive was quoted saying they expect prices to climb this summer.
As that pre-tariff inventory runs out.
Exactly, and replaced by cars subject to the new duties. Plus, you had Trump himself saying he didn't really care if foreign car prices went up.
So the writing's kind of on the wall for car prices, at least in the near term. Could hit household budgets hard.
Definitely looks that way.
Okay, shifting gears. What about housing? The MarketWatch article mentioned federal job cuts possibly softening demand.
Yeah, they linked potential job cuts to maybe cooling buyer demand a bit. But here's the weird part. Home sales in March were actually down nearly 6% year over year.
Okay, so fewer sales. Prices must be coming down too.
You'd think so, but no. The median home price actually hit a record high for March. Over $403,000, according to the National Association of Realtors.
Fewer sales, higher prices. That doesn't quite add up intuitively.
It is complex. Lawrence Yin, NAR's chief economist, pointed out that household wealth in housing is at record highs, which is great if you own.
But terrible if you're trying to buy.
Right. He basically said a slowdown in price gains would be welcome for affordability. The barrier to entry is still really high.
And it's not just buying. Rents are climbing too.
Second month in a row, according to apartment list data cited by MarketWatch. Median rent hit $1,384 in March.
And the key stat there was rents are still 20% higher than January 2021. That's a big jump that hasn't gone away.
A huge jump. And it's hitting some places harder than others. Fresno, Providence, Chicago, they saw the fastest year-over-year rent hikes in March.
So this housing affordability crunch is hitting renters and potential buyers, and it's not easing up everywhere.
Seems to be the case.
All right, let's pivot into personal savings and credit. MarketWatch noted a small increase in the savings rate in February, up to 4.6%.
Yeah, a slight uptick. Could be, a sign people are getting a bit more cautious with all this uncertainty we're talking about. Tariff worries, maybe.
Makes sense. And weren't there some moves in Congress on credit card rates? Bipartisan bills?
There were. Bills introduced in both the House and Senate aiming to lower those sky-high interest rates. So there's definitely recognition of the pressure consumers are under.
But did anything actually change?
Well, according to MarketWatch, not really. The average APR on cards accruing interest was still near 22% in Q1, and new cards in April, even higher, over
Yeah.
24%.
Ouch. So talk but no action yet for consumers' wallets.
Ted Rossman from Bankrate suggested it's tied to the Fed holding rates steady and just general economic uncertainty. Issuers are hesitant to cut rates.
And with the average balance around 6,500 bucks, those rates really bite.
They absolutely do. A big drain for a lot of families.
Okay, one last point from that Market Watch 100 Days piece. Student loans and credit scores.
Ah, yes. We saw that dip in the average Vantage score back in February, right when those student loan delinquencies started hitting credit reports again after the pause ended.
Shows the direct impact of policy right there.
Clearly. We also saw small upticks in auto loan and some mortgage delinquencies around the same time year over year.
But the score bounced back slightly in March.
It did, a little bit, up to 702. So the full impact of student loan payments restarting, it's probably still playing out. Could see more volatility there.
Okay, so that first 100 days picture is, well, it's mixed. Some stability, lots of tariff anxiety, weirdness in housing, maybe a bit more saving, and credit scores feeling the student loan effect.
A very mixed bag, yeah.
Now let's talk about another major pressure point, property taxes. MarketWatch had another piece titled, "A Property Tax Revolt is Underway Across the Country." Sounds serious.
It does. The main point is that sharp rises in property taxes aren't just local stories anymore. It's become a national conversation.
And the data backs that up.
Seems so. Adam data showed over 72%, almost three-quarters of metro areas with 200,000 plus people, saw property tax bills go up faster than the national average last year.
Wow. And the national average itself went up, what, 2.7%?
Yeah.
So most places saw even bigger jumps.
Exactly. The average bill hit about $4,172 in 2024. But the range is huge, obviously. New Jersey over 10 grand, West Virginia just over 1.
Location, location, location in taxation.
Right, and why are they rising? Mostly property values going up, plus rising costs for local stuff, schools, services.
So it's a combination of factors hitting homeowners.
Yeah. Rob Barber at Adam mentioned it's not just values, but also how taxes are assessed and just the rising cost of running towns and cities.
And this is fueling what some are calling a revolt.
That's the term Jared Walczak from the Tax Foundation used. He compared it to the anti-tax mood back in the 70s. And we are seeing states like Iowa, Kansas, Florida looking at significant reforms.
So politicians are noticing. What about the federal side? The SALT deduction cap.
That's a big looming issue. The $10,000 cap on deducting state and local taxes that came in with the 2017 Trump tax cuts, those cuts are set to expire.
So if the cap goes away or changes, that could really impact homeowners, especially in high-tax states.
Huge potential impact. And Kim Rubin from the Lincoln Institute of Land Policy added another layer.
Oh, yeah. What was that?
She linked the focus on property taxes partly to federal pandemic aid running out for states and cities, and also the whole work-from-home trend hitting commercial property tax revenues.
So cities are losing money from offices, and federal help is gone. They lean more on homeowners.
That seems to be part of the dynamic, and it comes just as other home cost insurance, utilities, maintenance are also rising.
It's a perfect storm for homeowner budgets. Are
Right.
people pushing back?
Definitely. Surveys show growing anxiety. And MarketWatch highlighted Texas Travis County saw homeowners contesting their tax bills jump from under 30% in 2022 to about 42% last year.
That's a massive increase in challenges. People are feeling it.
Clearly. And while the Northeast and Midwest generally have higher taxes, even places like Colorado, with historically lower rates, saw big enough jumps to trigger relief legislation.
So it's widespread. As Kim Rubin said, local governments have some hard decisions ahead.
Balancing budgets versus affordability, it's a tough spot.
Okay, from property taxes, let's do a complete 180. Crypto. Bloomberg had a headline that caught my eye. Bitcoin outpaces stocks in biggest weekly gain since election.
Yeah, that was a pretty big move. Bitcoin jumped about 12% in a week, getting close to $95,000.
And that beat the NASDAQ 100 during the same period.
It did. Which is interesting because even though Bitcoin isn't directly subject to tariffs like, say, steel is,
Right.
its price still tends to move pretty closely with tech stocks like the NASDAQ. It trades like a risk-on asset these days.
So despite its origins as separate from the system,
It's still heavily influenced by the wider market mood. Jake Ostrovskis from Wintermute basically said macro and geopolitical stuff are still the main drivers for crypto flows, even if the crypto market itself is broadening a bit.
But it did outperform gold recently, reminding people of that digital gold or store of value idea.
Yeah, that narrative pops up whenever it has a strong run, especially relative to traditional assets.
Okay, staying in the markets, but back to traditional industry. Bloomberg also reported on Cemex, the big cement maker. Spemex profit plunges on lower sales volumes in U.S., Mexico. Doesn't sound good.
No, definitely a challenging quarter for them. Profits dropped significantly because they just sold less cement and concrete, particularly in the US and Mexico.
Key markets for them, right?
Absolutely. Their operating EBITDA, that's a core profit measure, fell 18%, which was worse than analysts expected, suggests weaker construction demand.
Are they just taking it on the chin or trying to respond?
Oh, they're responding. Bloomberg mentioned they've been raising prices where they can, selling off some non-essential assets.
Streamlining things.
Right. And they're apparently looking at smaller acquisitions, specifically in the U.S., and they just appointed the guy who ran their U.S. business as the new CEO.
Signaling the U.S. market is still crucial for their future.
Exactly. Despite the current dip, they seem focused on the U.S. long term. Hedging against the strong dollar helped them a bit too, and cost cuts are ongoing.
Okay, let's switch over to ETFs, exchange-traded funds. Always a busy area. Bloomberg's headline, ETF frenzy for retail daredevils goes on despite market turmoil. Frenzy. Daredevils!
Aha, yeah, maybe a bit dramatic, but the pace of new ETF launches is still really high, averaging 75 a month this year compared to 59 last year.
So even with market uncertainty, new funds keep coming.
They do, and it's not just plain vanilla index funds. A lot of the new ones are, well, more speculative.
Like
Leveraged funds that magnify gains and losses, thematic funds on niche things like nuclear power, even complicated arbitrage plays linked to Bitcoin-related stocks.
stuff the average investor might not fully grasp.
Potentially. Todd Sohn at Strategists was quoted questioning if we really need all these or if some are just chasing day trader hype.
And Defiance ETFs is pushing the envelope.
Seems like it. They filed for funds trying to profit from volatility decay in Bitcoin proxies and triple leveraged NASDAQ funds, definitely not for conservative portfolios.
Triple leveraged?
Yeah,
Wow. High risk, high reward, potentially.
extremely. Henry Jim from Bloomberg Intelligence called some of these double short funds innovative, comparing them to complex arbitrage trades. We're also seeing more Bitcoin products, hedged international funds, even Japan small cap funds.
It's a very dynamic, maybe even confusing landscape for investors right now. Need to do your homework.
Absolutely critical.
Okay, let's shift from ETFs to global diplomacy and trade. The Wall Street Journal had a piece. Goldman Sachs offers advice on tariffs to countries scrambling to please Trump.
Interesting glimpse behind the curtain.
Very. It focused initially on U.S.-South Africa relations getting strained again, partly over land reform issues there. It even got to the point where the U.S. expelled their ambassador.
Wow. And South Africa was worried about tariffs.
Apparently, officials voiced concerns to Goldman execs about punitive tariffs hitting their exports, and Trump did impose reciprocal tariffs in early April.
But then paused them.
Yeah, a 90-day pause. The journal sources suggested this pause might be extended country by country, depending on how trade talks go.
So a negotiating tactic.
Looks like it. The administration seems to be planning talks with batches of countries, maybe 6 a week through July, but holding off announcing deals until they have several lined up.
And this was a hot topic at the IMF meetings.
Huge topic.
Yeah.
Treasury Secretary Besson apparently sees a long, maybe 2-3 year negotiation with China, aiming to reset trade, not fully decouple.
And Jamie Dimon's take. JP Morgan CEO. A bit grim. He suggested a mild U.S. recession might be the best case outcome from the trade war.
Oof, that's sobering. And other countries are negotiating too.
Yeah, Vietnam reportedly trying to lower potential tariffs. Japan talking about exchange rates. Lots of diplomatic maneuvering happening.
All this trade tension and potential policy shifts, it's impacting how foreign investors see the U.S. dollar in stocks, right? Bloomberg had an article on that.
Right. Foreign investors face bigger S&P 500, NASDAQ losses as dollar slides. It highlights a real problem for international investors holding U.S. assets right now.
The double whammy, as they called it.
Exactly. Stocks going down, and AD the dollar weakening means their U.S. holdings are losing value on two fronts. Benoit Pele from Natixis called it that double whammy.
And this is making them hedge more, protect against the dollar falling further.
We're seeing signs of that. Both Morgan Stanley and Bank of America reported more clients looking for ways to hedge dollar exposure. Alexander Hezes at Groupe Richelieu said his funds are max hedged.
Is this a big shift? Weren't they less hedged before?
Generally, yes. The thinking used to be the dollar might strengthen in a crisis. but that seems to be changing. Still, hedging levels aren't back to where they were in, say, 2020.
But if they did go back, Bank of America had an estimate.
A huge number. Potentially another $5 trillion of foreign-held U.S. stocks could get hedged if levels return to pre-pandemic norms.
Wow, how does that hedging work? Is it expensive?
Usually involves selling dollars forward. And yes, Bloomberg notes the cost has gone up recently because currency markets are more volatile. Shoki Omori from Mizuho mentioned the pain for managers who bought dollars when it was stronger.
But not everyone is rushing to hedge.
No. Some, like Fairs Hendy at Prevoir, point out currencies are just hard to predict. Plus, the counter-argument is the U.S. still has deep liquid markets and strong companies. A weaker dollar isn't necessarily a collapse.
Sure, but the big question is, does this signal a gradual withdrawal of foreign money from the U.S.?
That's the multi-trillion-dollar question. Allianz suggested there aren't many easy alternatives for that much capital, but even small shifts could really move exchange rates and asset prices.
And some banks are predicting longer-term dollar weakness.
Deutsche Bank and Danske Bank were mentioned as seeing the dollar weakening and the euro strengthening over the longer haul.
So this whole environment trade uncertainty dollar questions makes it tricky for investors trying to figure out what happens next. MarketWatch looked at this.
Yeah, the article, How Stock Market Investors Are Navigating the Wait for Trump Trade Deals, the core idea is that tariff uncertainty is just overshadowing everything else right now, even upcoming economic data.
Even though we have jobs numbers, inflation, GDP coming up.
Investors will watch them, sure, but there's this underlying fear that the tariffs announced April 2nd, the Liberation Day tariffs, could do longer-term damage.
And we're seeing markets react differently, Europe versus U.S.
A bit of a divergence since early April. European stocks have generally held up better or risen slightly, while the S&P 500 has struggled.
MarketWatch gave specific ETFs.
Right. The iShares MSCI ACWI ex-US ETF and the Vanguard FTSE Europe ETF both did better than the S&P 500 since April 2nd. Now, Europe has its own drivers, defense spending, German infrastructure.
But they're not immune to U.S. tariffs either.
Yeah, why not? It's complex. Phil Camporial from JP Morgan Asset Management said tariffs are just overwhelming the narrative, leading them to be more neutral on stocks and bonds globally.
And the expectation is these negotiations will take a long time.
That seems to be the view. Deladerriere suggested it could be months, even years, to reshape trade, with different tariff levels for different sectors and countries.
So what do markets need to see?
Some light at the end of the tunnel, as Deladerriere put it, some sign of progress or clarity. Until then, the focus is on quality companies, those with pricing power, good margins, strong cash flow.
Companies that can maybe weather the storm better.
That's the idea. And while the near-term U.S. data might not show the full tariff impact yet, the uncertainty itself is probably making businesses hold back on hiring and spending. So the expectation is for U.S. growth to slow down.
Even though the S&P had a recent bounce, it was still down for April after the tariffs hit. Though some see dips as buying opportunities.
Always depends on your time horizon and risk tolerance, of course.
Now, related to all this uncertainty is inflation fear. The Wall Street Journal had a piece. Inflation fear is making some people spend more and others less. How does that work?
It's fascinating, right? The idea is if you expect prices to go up, you might buy now, pull forward purchases.
Makes sense. Beat the price hike.
But that urge can be canceled out if you're also worried about losing your job or the economy tanking, especially for lower-income households.
But it depends on which fear is stronger, inflation or recession.
Kind of. Bank of America data showed lower-income spending growth slowed more than higher income in March, which sort of contradicts older research. A 2021 Dallas Fed study suggested lower-income folks might spend more on durables ahead of inflation, maybe hoping inflation eats away their debt. But that same study said if job loss fears are high, people cut spending regardless of inflation expectations.
So perceived risk trumps inflation expectations sometimes.
Seems plausible. Brian Doubles, Synchrony CEO, actually saw the overall spending moderation as a good sign for credit health people aren't overextending.
And lower income wage growth was slower too.
Yeah, that likely plays a role in their caution.
Yep.
Interestingly, the WSJ noted a pullback in nice-to-have spending restaurants, travel in Feb-March.
But durable goods spending picked up in March, and auto loan applications.
Right. So maybe a shift, cutting back on experiences, but perhaps still buying some physical goods, maybe ahead of expected price rises. It's complex consumer behavior.
Definitely. Now let's talk about the market darlings, or maybe former darlings, the Wall Street Journal. Magnificent Seven stocks have lost $2.5 trillion in market value so far this year. That's a staggering number.
It really is. Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla collectively down $2.5 trillion. Their worst start to a year since 2022.
And each one down significantly.
Every single one down more than 6.5% year to date at the time of the article. Even the ETF tracking them, despite a recent bounce, was still down about 15% for the year.
What's driving this? Is it just broad market weakness or specific issues?
A mix of things, according to the journal. You've got the emergence of DeepSeek's AI challenging U.S. tech dominance, maybe. The whole Trump trade war shaking confidence in that American exceptionalism tech trade.
And company-specific stuff, too.
Oh, yeah. Tesla's profit drop, Nvidia facing China export curbs, Apple's weaker iPhone sales and perceived AI delays, Alphabet's ad business potentially hit by tariff rule changes. It's a list.
Matt Orton at Raymond James called it a shift from magnificent to maleficent.
Yeah, a catchy, if slightly ominous phrase. The expectation is their era of just completely dominating earnings growth might be fading.
And the worry is their slump drags the whole market down.
It's a valid concern. The S&P 500's overall return looks much worse if you strip out the Mag 7's contribution historically. If they're struggling, it makes a broad recovery harder.
Even though some analysts still think their valuations are high.
Valuations are always debated, but the recent performance certainly gives the bears more ammunition.
Okay, so with that backdrop, tech earnings season becomes even more critical. MarketWatch previewed this. More tech heavyweights set to report earnings after Alphabet offers some hope amid tariff fears.
Yeah, huge anticipation, but also a lot of nervousness around Microsoft, Meta, Apple, Amazon reports. How is the trade war really hitting tech spending, AI, cloud, ads, online shopping? What about prices, supply chains?
Ripple effects too, right? Like on data centers.
AI budgets.
Exactly. Alphabet's report was seen as somewhat positive. They're still spending on CapEx. Cloud grew well. But then IBM sounded more cautious, saying they hadn't seen a material change yet, but we're watching closely.
So what are investors watching for specifically in these upcoming reports? For Microsoft and Meta, AI and cloud demand strength, obviously. Also, are those big Chinese advertisers like Temu and Shein cutting back? That could hit Meta and Amazon.
And Amazon. Inventory, supply chain adjustments, AWS performance.
Okay. For Apple, did people panic buy ahead of tariffs? What's the status of shifting production to India, component tariffs, and that AI assistant delay narrative?
It really underscores how vital these companies are to the market overall.
Massively. MarketWatch cited FactSet data showing S&P 500 earnings growth looks way wetter if you exclude the Mag 7. Though both analysts think cloud spending will stay strong, maybe data center growth peaks soon.
But overall profit margins for the S&P 500 are still healthy.
Generally, yes, which is a positive sign amidst the worries. And beyond tech, MarketWatch mentioned watching earnings from McDonald's, Starbucks, GM, UPS, Visa, PayPal, Etsy.
A broad range to gauge consumer spending, auto industry vulnerability, shipping.
Exactly. Lots of data points coming.
Now, amidst all this doom and gloom about trade wars and weak dollars, Morgan Stanley's Michael Wilson has a different take. Bloomberg reported on this.
Yeah, a contrarian view. Morgan Stanley's Wilson says weak dollar will buoy U.S. stocks. His argument is basically that a weaker dollar helps U.S. companies' overseas earnings.
Makes the products cheaper abroad, boosts profits when converted back to dollars.
Right. He thinks U.S. companies have less volatile earnings and higher quality overall, so a weaker dollar actually helps them outperform international stocks.
That definitely goes against the grain of some other strategists worried about Trump's policies.
It does. People like Elaine Bukobza at Sagen and folks at Bank of America have expressed more caution about U.S. stocks and the dollar if the current trade stance continues.
This ties into a really interesting opinion piece in MarketWatch. Opinion. U.S. economic growth benefits from this secret sauce that Trump is spilling. What's the secret sauce?
Ricardo Hausman argues it's America's ability to create value from ideas, innovation, expertise, intangible stuff he calls dark matter.
So not just about making physical goods.
Exactly. He challenges the traditional view that the U.S. trade deficit is purely bad. He points to the U.S. surplus in services and the huge income generated by U.S. companies' foreign operations.
Suggesting the U.S. exports invisible capital, like knowledge and brands.
That's his argument. And he says U.S. strength historically came from protecting cross-border investment and intellectual property, allowing it to profit from this dark matter.
And Trump's tariffs threaten this.
Hausman argues yes, that focusing just on goods trade and putting up barriers risks damaging this foundation of U.S. power. Not just trade, but attracting talent, funding research, the whole knowledge ecosystem.
Geopolitical consequences, too. Allies hedging. China decoupling.
He raises those concerns, even compares it historically to Kaiser Wilhelm II messing up Bismarck's alliances. His warning is stark. Misunderstanding the trade deficit could create a real crisis. It's a very different way of looking at U.S. economic strength.
Definitely food for thought. Shifting gears again, a familiar name popped up in Bloomberg. Price Al-Walid's Elon Musk ties are boosting his comeback bid. Prince Al-Walid is back in the spotlight.
Seems so. After keeping a lower profile following his detention back in 2017 in Saudi Arabia. The article suggests he's feeling more confident now, perhaps linked to Trump's election and Elon Musk's influence.
He's still incredibly wealthy, right? A major investor historically.
Oh yeah, Fortune estimated near $18 billion. Big stakes in Citigroup, News Corp, Disney over the years. Used to be a key contact for Wall Street looking at Saudi Arabia.
But things changed under MBS. The Public Investment Fund got bigger.
Right. Saudi Arabia opened up more, PIF became the dominant player, but Al-Walid still seems influential, partly thanks to PIF investing in his Kingdom holding company.
And his ties to Musk are key now.
Very key. He's a significant shareholder in XAI and X-Twitter. That keeps him relevant in tech and finance circles.
And he has a history with Trump, too.
Long history, business deals in the past. Apparently congratulated Trump privately after the re-election via contacts. Jim Crane was quoted saying Al-Walid is still relevant, can exert influence.
Interesting dynamics there. Okay, back to the markets right now. Bloomberg stock market today. Live updates for Monday, April 28th. What was the mood?
A little cautious. Futures dipped slightly as investors braced for that big week of earnings we talked about and kept an eye on U.S.-Asia trade talks.
Has the volatility from the April 2nd tariffs calmed down a bit?
Somewhat eased, yeah. But the focus is squarely on earnings now. How are trade policies actually hitting bottom lines?
And still some hope for Fed rate cuts if data softens.
That hope lingers, yes. If economic data comes in weaker than expected, maybe the Fed moves sooner. The market had rallied for 4 days straight before Monday, showing some resilience.
But all eyes on earnings from Microsoft, Apple, Meta, Amazon, and Friday's jobs report.
Absolutely critical week. Kathy Jones at Schwab pointed out the near-term data might not fully show the tariff impact yet, making things like the ISM manufacturing report and jobs data even more important for clues.
And the Trump team is working on a negotiation framework.
Reportedly drafting one for talks with about 18 countries, so the trade story is far from over.
Okay, zooming in on one specific tech giant, NVIDIA. MarketWatch had a piece where Morgan Stanley dismissed a common worry about them.
Yeah. This common worry about NVIDIA is laughable, Morgan Stanley says. The worry is about an AI hardware digestion phase, basically. Companies pausing spending after buying so many chips.
But Morgan Stanley's analyst, Joseph Moore, isn't buying it.
Not at all. He called demand for inference chips, the ones that run AI models, explosive and durable. Said demand is way, way higher than current supply, tens of billions higher.
So investors might be nervous about an inevitable slowdown, but he doesn't see it yet.
He seems very confident. He actually raised his revenue and earnings estimates for NVIDIA for 2026, calling them likely very conservative. Doesn't think shifts in AI model types will hurt them either.
Strong vote of confidence there. Now, what about the bond market? Also showing signs of stress. Bloomberg talked about fear of the long bond.
Right. Treasury market's new world order brings fear of the long bond. The key takeaway is bond managers want more compensation, a higher yield for holding longer-term U.S. debt.
That's the term premium they talk about.
Exactly. It's reportedly near its highest since 2014. Why? All the uncertainties we've discussed. Trade war, future tax cuts, the big federal deficit, what the Fed will do.
So, more risk perceived in holding long-term treasuries.
That's the idea. Even adjusted for inflation, 30-year yields hit highs not seen since the financial crisis earlier in April. Rebecca Venter from Vanguard thinks that premium could go even higher.
Why? Deficits and more bond issuance.
Yep, Vanguard expects weak U.S. growth, which makes the deficit worse, meaning more bonds need to be sold, and a higher term premium means it costs the government more to borrow.
A potential feedback loop. BlackRock is worried too.
Yeah, growing concerns about government finances making U.S. bonds more vulnerable if investor confidence wobbles.
Okay, one last piece connecting tariffs to the real economy. MarketWatch. What a plunge in shipping traffic from China says about tariffs, stocks, and the economy. A plunge.
A significant drop, yeah, in container ships leaving China for the U.S. recently. Steve Blitz from Global Data TS Lombard explained it as the backwash after front-loading.
Meaning companies rushed imports in Q1 before tariffs hit.
That's the theory. Get goods in ahead of time. So now, shipping volumes are dropping off that peak. Blitz thinks the main impact we'll see now is higher prices, not necessarily shortages.
The White House met with retailers about this.
Reportedly, yes, discussing the tariff implications. The article stressed that the anxiety itself is hurting consumer and business confidence, regardless of the final tariff details.
And still so much uncertainty about the China talks.
Huge uncertainty. John Canale at TIAA expects businesses might pull back spending, hitting profits. Blitz emphasized the issue now isn't supply, it's price.
And people were even using more expensive air freight to beat the clock.
Apparently so. Shows the lengths businesses went to manage the tariff risk.
So in this messy market, what are strategists recommending? Morgan Stanley had another view in MarketWatch.
Right, with the S&P 500 looking stuck, investors should seek out stocks that have already priced in bad news. Their view is the S&P 500 is stuck in a range for now.
So look for bargains among stocks that have already been beaten up.
Specifically, high-quality cyclical stocks companies sensitive to the economy where the price already reflects an expected earnings slowdown or even a mild recession.
They think the market hasn't fully priced in a potential downturn yet.
Their strategists said the market isn't pricing in a labor cycle mild recession yet.
Yeah.
They're watching jobs data and the ISM manufacturing report very closely.
Did they name specific stocks?
They listed their top 5 from a new screen: NOV, Kinder Morgan, PPG Industries, Rocket Lab, and Wilscott Holdings. Mattel and Nike were also mentioned.
Interesting. And they still prefer U.S. stocks because of the weak dollar view.
Yes, sticking with that theme, weaker dollar helps U.S. earnings, making U.S. stocks more attractive than international ones in their view.
Okay, and just wrapping up with one company-specific positive story amidst the political noise. WICHI AppTech.
Yes, Bloomberg reported WICHI AppTech revenue beats estimates on strong U.S. sales. Despite political pressure in the U.S., the Chinese biopharma company beat Q1 revenue forecasts.
Driven by U.S. sales.
Significantly, U.S. comparable revenue jumped 28%. Their chemistry division grew 33% globally. And they maintained their full-year forecast. Shows some resilience.
Okay, wow. That was a lot to cover.
Mm-hmm.
So pulling it all together, what's the big picture takeaway from all these headlines?
It's definitely complex. You've got this mix of consumer caution, but also some continued spending. Huge anxiety about tariffs hitting various sectors. Financial markets are volatile with some surprising pockets of strength like Bitcoin recently.
And just overarching uncertainty about where economic policy is headed under Trump.
Exactly. It's a landscape that demands attention.
Absolutely. And for you, listening, really understanding these different threads, potential inflation from tariffs, what's happening in housing and credit, how different assets are behaving, it's all pretty crucial for making your own financial decisions right now.
Mm-hmm. We'd really encourage you to think about how these trends might play out in your own situation, your own financial plan.
It's definitely a time for careful consideration and staying informed.
Couldn't agree more.
Well, that's all the time we have for today's deep dive into these major financial headlines.
Thanks for tuning in.
We'll see you all tomorrow morning with new headlines from major financial magazines.